You have been taught that debt is a personal flaw, a bad choice, something that happens only when people misuse credit or buy things beyond their means. But what if that idea is wrong? What if the entire system is built not just to permit debt, but to depend on it? Not as an error, but as its foundation. Because here is what few people are encouraged to see. A society buried in debt is far easier to manage than a society that owns its time. And those who design the system understand this very well. They always have. This mechanism is older than banks, older than credit cards, older than mortgages. It stretches back thousands of years. And every time a civilization discovers how to lock its people into endless obligation, the outcome is the same. The many labor endlessly for the benefit of the few. Freedom becomes rare. Escape becomes nearly impossible. The uncomfortable reality is that debt is not an accident in your life. It is a feature of the structure you live inside. You are not trapped by chance. You are trapped by design. Let us begin with a system most people believe they already understand: medieval serfs. When you imagine a serf, you likely picture someone legally bound to land, without freedom or rights. That image is partly correct, but it misses the most important detail. Serfs were not slaves in the traditional sense. They were not bought or sold in markets. What bound them was not chains, it was obligation. In medieval Europe, peasants worked land they did not own. The lord controlled the fields, the mills, the ovens, even the forests. To grind grain into flour, the peasant used the lord's mill and paid a fee. To bake bread, the lord's oven was required and paid for again. Gathering firewood required permission and payment. Hunting animals to feed one's family was forbidden because even wildlife belonged to the lord. After paying rents, tithes, and fees, most peasants were left with barely enough to survive. And when a poor harvest arrived, or illness struck, or tools broke, borrowing became necessary. The loan came from the lord, always with interest. Suddenly, the peasant was not simply working the land. They were working to repay a burden that could never truly be lifted. This was not a flaw in the system. It was the purpose. A peasant who cleared their debt might leave, might demand better terms, might gain leverage, but a peasant weighed down by obligations stays. Works, obeys, and passes those obligations to their children. This should sound familiar, because the structure remains the same. Only the language has changed. In medieval times, peasants surrendered roughly a third of their labor through taxes and fees. Today, the average worker hands over an even larger share through taxation alone. Add housing debt, education loans, vehicle payments, and consumer credit, and suddenly most people are working the majority of their lives just to service obligations. This is not freedom. It is financial servitude. And like before, the obligations are structured so release is always just out of reach. You can refinance, you can restructure, you can make minimum payments, but the balance lingers. Because if it vanished, you might choose differently. You might slow down, you might walk away, and the system cannot tolerate that. This pattern did not begin in the Middle Ages. It reaches further back, to ancient Rome. When people think of Rome, they imagine emperors, legions, and marble monuments. But for centuries, the true power was held by creditors. In the early Roman Republic, debt was ruthless. Failure to repay could result in debt bondage. A person's body became collateral. They worked the fields or households of their creditor until the obligation was satisfied, and if it never was, the burden passed to their children. Entire families lived in bondage not because of crime, but because of borrowing. This led to repeated uprisings. The poor demanded relief. The elite faced a choice: forgive debts and lose control, or enforce repayment and risk revolt. More often than not, they chose control. Eventually, Rome outlawed debt slavery for citizens. But the logic survived. Instead of binding bodies, the system bound labor, through taxes, rents, and dependency. By the late Republic, vast numbers of Romans were technically free, yet unable to stop working because their obligations never ended. And here lies the chilling lesson. Rome did not collapse primarily because of invasions. It collapsed because debt hollowed it from within. By the later centuries, so many people attempted to flee taxes and obligations that the empire passed laws forbidding workers from changing professions. Bakers were forced to remain bakers. Farmers could not leave their land. When a system reaches that point, it is already breaking, not with fire or conquest, but quietly, through exhaustion. Farmers were forced to remain farmers. Bakers were forced to remain bakers. People were legally bound to their professions because if escape were allowed, the entire structure would collapse. The empire slowly transformed into a cage. And even with all that control, it still disintegrated. Because no system can survive forever when the majority exists only to sustain the comfort of a few. Let that sink in. Ancient Rome, one of the most powerful civilizations ever to exist, chose obligation over freedom. And when people tried to flee that burden, the state criminalized escape. If that sounds extreme or impossible today, keep listening. Because a version of this system existed much closer to modern times. Company towns. In the 19th and early 20th centuries, mining companies in America, Britain, and other industrial nations discovered a method that was both efficient and cruel. Instead of paying workers in real currency, they paid them in company script. This script could only be used at the company store. Miners would descend underground, risk their lives, and at the end of the week receive tokens that were only valid where the company decided. Prices at those stores were always higher than in nearby towns. Basic food that cost a small amount elsewhere cost far more inside the system. Workers spent everything they earned just to survive. By the end of each month, many owed more than they made. And because they could not leave until the debt was cleared, and the debt never truly shrank, they were trapped. Entire families lived their entire lives inside these towns, never touching real money, never gaining independence. A famous song from the mid-20th century captured this reality. The message was simple. Each day of labor only made the debt deeper. The company controlled the work, the housing, the food, and the future, and all of it was legal. From the company's perspective, the system was elegant. There were no chains, no guards. Workers showed up voluntarily because the alternative was starvation. Stay and survive, or leave and lose everything. That is the essence of control through obligation. You do not need to imprison people physically if you can imprison them economically. The cage is invisible, but it is no less real. And this is the part that should feel unsettling. Company towns were eventually banned. Paying workers in script became illegal. We look back on that era and call it exploitation. But the mechanism itself never disappeared. It simply evolved. Today, workers are paid in national currency, but that currency flows directly into commitments that are nearly impossible to escape. A paycheck arrives and vanishes almost immediately. Housing payments, transportation payments, education loans, insurance, minimum balances. What remains is just enough to get through until the next cycle. The lyrics of that old song still apply. Each day older, each day deeper in obligation. Now consider a larger scale example. After the Second World War, the victorious nations faced a dilemma. Germany owed massive reparations. If those debts were fully enforced, the economy would collapse. Hyperinflation would return. Political extremism would rise again. So the debts were largely forgiven. Germany was rebuilt. It was integrated into a new economic system. Why? Because a nation crushed by obligation is dangerous. A nation that can produce, trade, and consume is profitable. The lesson was clear. Obligation is useful only when it controls without killing the source. But here is the critical distinction. That lesson was applied to countries, not to individuals. Governments learned that manageable obligation keeps economies functioning. But for citizens, the calculation changed. A population buried in personal obligation does not revolt. It does not organize. It does not have the energy or time. It works. It pays. It consumes. And it stays silent. That is why in the decades after the war, when wages stalled and costs climbed, the solution was not higher pay or affordable housing. It was expanded credit. Education became a loan. Homes became lifelong payments. Transportation became financing. Even food could be delayed onto plastic. The system shifted from paying people enough to live to lending them enough to endure. And that difference is everything. By the late 20th century, credit cards were issued to the young. Housing loans required little verification. Education debt could not be erased, even in bankruptcy. And all of this was marketed as freedom. Freedom to choose, freedom to invest, freedom to own. But it was not freedom. It was obligation dressed as opportunity. Because the moment you accept long-term debt, your time is no longer yours. Each month, a portion of your future is already claimed. Leaving a job becomes risky. Saying no becomes dangerous. Survival depends on compliance. And that is how control no longer needs force. It only needs obligation. You cannot take a real risk on a business or a personal dream because you need predictable income just to service what you already owe. You cannot move to a cheaper place or chase a better opportunity because you are locked into a mortgage or a long lease. Debt does not only drain your money, it removes your choices. And that is exactly the purpose. A population with choices is unpredictable. A population burdened with obligations is obedient. Now this is where the system grows even more unsettling. Inflation. Most people are taught that inflation simply means prices rise. That part is true. But what is rarely explained is who inflation rewards and who it punishes. If you hold cash or rely on a fixed salary, inflation quietly eats away at your wealth. Your savings lose strength. Your income buys less with each passing year. But if you own assets like property stocks or commodities, inflation works in your favor. And if you hold large amounts of debt, inflation becomes a powerful ally. The debt you owe today will be cheaper tomorrow in real terms. Think about this. Someone who borrowed a large sum to buy property decades ago watched inflation reduce the true weight of that obligation year after year. They repaid old debt with weaker money. Those with wealth understand this dynamic. That is why they borrow aggressively and place that borrowed money into assets that rise with inflation. For them, inflation is leverage. For the average person, the story is reversed. Most people borrow for things that lose value. Education that may not increase income. Vehicles that depreciate immediately. Credit balances used for daily expenses already gone. So inflation strikes twice. It raises the cost of living while making debts harder to escape because wages lag behind. This is the quiet mechanism at work. Inflation shifts value from workers and savers to asset owners and heavily leveraged institutions. And governments favor inflation because it reduces the real weight of their obligations while creating the illusion of growth. Now look at the modern era. In the late 2000s, the global financial system nearly imploded. Banks issued reckless loans, bundled bad mortgages, and gambled with money that did not truly exist. When the system broke, ordinary people paid the price. Homes were lost. Jobs vanished. Lifelong savings evaporated. And what happened to the banks? They were rescued. Trillions in newly created money were injected to stabilize them. That money did not disappear. It re-entered the economy as obligation. Governments absorbed it, central banks manufactured it, and the public absorbed the cost through taxes, rising prices, and stagnant wages. The rescue was not a bailout of society. It was a transfer of power and wealth. The losses were shared by the public. The gains remained private. If you failed to pay your mortgage, you were removed. If a bank failed, it was saved. Responsibility flowed downward. Protection flowed upward. Then came the global shutdown of the early 20s. Governments closed economies and created massive amounts of money to prevent collapse. In a short span, more currency was issued than in generations before. A small portion reached households. Most flowed into corporations, financial markets, and assets. Stock prices surged. Property values soared. The wealthiest accumulated unprecedented gains. Meanwhile, living costs climbed. Rent rose. Food became more expensive. Incomes barely moved. Those without assets were left further behind. Once again, obligation and money creation shifted wealth upward. And you will pay for it. Through inflation, through higher prices, through a future where each unit of income carries less power than before. This is the illusion. You are told that debt is a personal choice, that inflation is a natural force. But it is neither accidental nor neutral. It is structural. It keeps people working. It keeps consumption steady. And it prevents independence from forming. Nowhere is this clearer than in education debt. Decades ago, public education cost a fraction of what it does today. Now, the price has multiplied far beyond wages. This was not natural inflation. It was engineered. Then, lawmakers ensured that education loans could never be erased, even through bankruptcy. Credit card debt can vanish. Medical debt can disappear. But education loans remain forever. Why? Because they are guaranteed. They are risk-free for lenders and permanent for borrowers. The moment you sign for that obligation, you surrender decades of future income, and the system knows it. Banks are designed so they cannot truly lose. If you default, the state steps in. The loan is covered. Then the state turns around and collects from you for decades through wage deductions, tax refund seizures, and even reductions in future social benefits. Escape is almost impossible. This creates a deeply distorted incentive structure. Universities can raise tuition endlessly because students can always borrow more. Lenders issue loans freely because the risk is removed. And young people who have been told their entire lives that education is the only road to survival sign contracts they barely understand. By the time they graduate, they carry obligations that can reach tens or even hundreds of thousands. And what do they receive in return? Often a credential that does not guarantee income sufficient to repay what they owe. But this is not a failure of planning. It is the design. Because the brilliance of the system is not the loan itself. It is the duration. That obligation follows you for decades. It delays buying a home. It delays forming a family. It delays saving. It locks you into jobs you dislike because missing a payment is not an option. And by the time you finally reach stability, you no longer have the energy or freedom to change course. You simply work until you are no longer able to. Education debt is not a malfunction. It is infrastructure. It anchors an entire generation into dependency. Housing debt works in much the same way. The long mortgage is marketed as ownership and security. But in reality, for the first half of that agreement, most payments go to interest. You are not building ownership. You are paying rent to a financial institution. And when life forces you to move, which most people do every few years, fees, refinancing, costs, and penalties erase much of the progress you thought you made. Many people spend a lifetime paying interest without ever truly owning the asset. Even if you complete the mortgage, the illusion continues. Property taxes ensure that ownership is never absolute. Miss enough payments, and the property can still be taken. So the payments never really stop. They only change recipients, Credit cards are the most visible form of this trap. Households carry thousands in revolving balances at rates that guarantee years of repayment. Making minimum payments stretches survival expenses across decades. Food fuel emergencies. Not indulgence, but necessity. These cards are not symbols of excess. They are pressure valves in an economy where wages stopped matching reality long ago. And every month that balance exists, income flows upward, quietly, consistently, endlessly. The pattern repeats across history. Medieval peasants paid endless fees. Roman citizens were bound to obligation. Industrial workers were trapped in company towns. Today, the labels are different, but the outcome is identical. Work, pay, repeat. This is not random. It is systematic. Debt is not merely tolerated, it is required. Because debt is leverage. Someone without obligations can walk away. They can refuse unfair conditions. They can build alternatives. Someone burdened with debt cannot. They accept longer hours, lower pay, fewer rights. Not because they lack courage, but because they lack options. Debt strips leverage. It converts independence into compliance. And here's the core truth. The system does not just benefit from your debt. It depends on it. Modern money is born as obligation. When a loan is issued, new currency is created. It exists only because someone promised future labor to repay it. Without debt, the system stops expanding. Without borrowers, there is no growth, no profit, no control. That is why freedom is discouraged and obligation is normalized. Because an indebted population is predictable, manageable, and profitable. And that is why this is not a personal failure. It is structural. If everyone cleared their debts at the same time, the money supply would shrink violently. Lending would stop, spending would freeze, the economy would stall. The truth is uncomfortable but simple. The system does not function without debt. It requires you to carry it, roll it forward, and eventually hand it down. And here's the part that should disturb you. The institutions that design this system understand it perfectly. Banks understand it, governments understand it, corporations understand it. This is not ignorance, it is intention. That is why borrowing has been made effortless, while saving has been made painful. That is why wages have barely moved while housing, education, and healthcare costs have exploded. That is why bankruptcy laws were rewritten to make certain debts inescapable. And that is why inflation is quietly accepted. Inflation lightens the burden for asset holders, while silently draining those who rely on wages and savings. Policy after policy nudges you toward borrowing and away from independence. Financial products promise convenience while extending obligation. And when you struggle under the weight of it all, you are told the problem is personal, that you lacked discipline, that you made poor choices, that you failed. That narrative is the final layer of control, because it shifts blame away from design and places it on the individual. You are not buried in debt because you are careless. You are buried in debt because the structure demands it. So what can be done? The first step is awareness. Debt is not neutral. It is not merely a financial instrument. It is a claim on your future time. Every balance you carry represents hours of your life already promised. The system will always offer new promises disguised as rewards. A larger home, a newer vehicle, a lifestyle upgrade. All of it financed, all of it extending the leash. Recognizing this does not make you free, but it gives you clarity. The second step is resistance. Reducing debt is difficult and often unfair. It requires sacrifice. Smaller spending, extra work, letting go of comforts that were marketed as necessities. But every obligation removed restores a measure of control. Every balance paid down returns a piece of your future. The third step is permanence. Once free from consumer debt, the challenge becomes staying free. That means building reserves, owning assets that are not easily eroded, and refusing the pressure to re-enter the cycle simply because it is normalized. Freedom creates leverage. With fewer obligations, you can walk away. You can refuse poor conditions. You can take risks. And that is precisely what unsettles systems built on compliance. Finally, understand this struggle extends beyond one lifetime. The same machinery that ensnared you is already targeting the next generation. Rising education costs, early fees, constant messaging that success requires borrowing. The cycle continues unless it is interrupted. History makes this pattern clear. Medieval peasants, Roman debtors, industrial workers, and modern households differ in appearance but not in function. Control no longer requires chains or guards. It requires balances and due dates. The most effective restraint is the one people accept, willingly believing it leads upward. But a society burdened by obligation is easy to manage. A society with autonomy is not. That is the real reason debt is encouraged and escape is discouraged. Because free people are unpredictable, and a population focused on survival has no time to challenge the structure that confines it.